Today we take a look at Cathie Wood's ARK Invest stock portfolio that is up 180% for the year. Now in this series we look at how the pros set up their portfolios and the successes and failures they've had with them. Now let's dive right in and see how Cathie Wood achieved such an amazing result. So what is ARK Invest? Well, ARK Invest is a specialty asset management company with one primary focus, and that is innovative technology securities. The company seeks out the most innovative products that are, in their opinion, going to have a large growth potential. In their own words, ARK Invest is all about the next big thing, meaning they don't want to focus on year-to-year results, financial ratios, and benchmarks. They just want products that will change the world dramatically, and they are looking for large gains. Now, if you can find these stocks, you are of course golden. However, this is not an easy task, but Cathie Wood seems to steer the company in the right direction, and they are achieving great results because of it. The ARKG investment strategy and performance. Currently, the ARKG portfolio has $7.67 billion in net assets, and since its creation, the fund has gained 30% annually. In the past year, the ARKG fund even managed to do 180%, which was of course during a very difficult time for most industries. But the fund managed to profit from the volatile market because of its positioning. ARKG zooms into biotech firms in the field of genetics, which include technologies such as CRISPR, targeted therapeutics, and stem cell R&D. Before we continue with the 10 biggest stocks in the fund, please like and subscribe to the channel for more finance and banking information. At number 10 on the list, we find Takeda Pharmaceutical, making up 3.12% of the portfolio. This is a Japanese-based medicine producer whose stock is trading at around $17.6. Now at first glance this might not seem like a very interesting company to invest in because of the disappointing 1.35% profit margin. However, this is not due to a lack of sales, since the company is raking in around $31 billion in revenue. Now currently the company is spending over $4.5 billion in R&D every year, which is around 14.5% of their total revenue. So this shows that if the company were to ease up on the R&D spending, or when the R&D spending starts paying off, there should be a lot of profit for the shareholders. So it could be that ARKG Invest has some insight into this outlook, either on the product side or on the financial management side. Number 9 and 8 on the list are Vertex Pharmaceuticals and CRISPR Therapeutics, with a 3.43% and a 3.47% respectively. Vertex Pharmaceuticals specializes in medicines treating cystic fibrosis and has been making good gains in the revenue for the past 4 years, going from around $2.5 billion to around $6 billion. This was strongly reflected in the share price, trading at around $90 in March 2017 and around $294 in July 2020. About 3 months later, the stock took a massive nosedive, dropping from around $268 to around $208, which was due to the company dropping a very promising pulmonary drug from their clinical trials. This was done for safety concerns, and it shows the danger from investing in pharmaceuticals. You have to wait a long time to get a sudden large gain. However, if the product fails, you might not get any gains at all. Number 6 and 7 are Caradex Incorporated and Roche Holdings. Roche's stock has pretty much stayed the same when looking back 1 year, showing that it did not profit from the volatility. However, it did manage to recover after the massive dip in the market. Roche is a much more stable giant in the pharmaceutical sector that does a decent 2.6% dividend yield. This almost makes it an odd investment for ARK Invest. Now with Caradex we have our first true winner that fits the ARK Invest doctrine perfectly. This stock has reached an all-time low in 2017, trading at just 87 cents, and fast forward about 4 years and it's trading at around $88. This is more than a 100x gain in just 4 years, and this is where Cathie Wood aims her funds at. She loves picking these very undervalued pharmaceuticals. It's also very difficult to find these, however now you have ARK Invest to do it for you. The 5th and 4th spot are taken by Exact Sciences and Regeneron Pharmaceuticals. Now Exact Sciences was hit very hard by the March downturn and fell all the way back to the December 2018 lows. Since then it has recovered very strongly and is doing around 3x, reaching an all-time high. Regeneron Pharmaceuticals has clearly profited from the economic changes, and it has seen its stock rise since the start of 2020, all the way into July, after which a major correction took place by early investors. At number 3 we find the Pacific Biosciences of Kaleef, which manufactures systems for gene sequencing. This is another Cathie Wood winner. At the beginning of 2020 this stock was not even doing $6, and by January 2021 it was trading above 36, so definitely a good call to have added this to the portfolio. However, it is a highly questionable trade, since looking at the fundamentals it would be very difficult to explain why you would buy. At the beginning of 2020, Pacific was running at a 3-year loss. The company managed to make a gross profit from sales of $34.7 million in 2017, $25.1 million in 2018, and $34.6 million in 2019. Now these gross profits got destroyed each year by the very high operating cost of $124, $126, and $135 million. Currently the company is running at a loss, so the extreme rally of the stock was very hard to predict. The second biggest stock in the ARKG portfolio is the Twist Bioscience Corporation, which is a company that makes synthetic DNA for the biotech industry. They have also not felt any negative effects during the economic downturn in March, and the stock has been steadily growing throughout the year, starting at $25 in January of 2020 and reaching over $207 a year later. Now, the number one stock in the ARKG portfolio is Teladoc Health, and as the name suggests, this is a remote healthcare service. This one should have been a no-brainer, of course, during the current economy and the massive shift towards working from home. Teladoc stock have skyrocketed from around $99 in the beginning of 2020 to around $249 in August, after which it had a pullback and stayed steady around $222 and is now climbing again, breaking $280. Now, Teladoc was running at a 5-year loss, and in 2019 financials looked pretty bad. The company had around a $100 million loss and $550 million in revenue. This all turned around in the quarters of 2020. When looking at the financials, the stock price does not always make sense. The second quarter results ending in June shows an almost doubling of the revenue to $241 million. However, the loss for the quarter remains almost unchanged at $25 million, but still the stock price shoots up during June and peaks in July after filing. When Q3 results are presented, the stock takes a nosedive even though the results are very strong. So it appeared that the merger dealing with Livongo that was going on at the time had a much bigger impact on the stock than the actual company financials. This did not make a lot of sense since the company only paid a 10% premium on the current share price in a combined cash and stock deal, and Livongo had presented very strong Q2 results. So to sum up, adding this stock to the ARKG portfolio with a long-term focus turned out to be a great deal. However, it's very hard to figure out why exactly it should have been based on these fundamentals. If the company had not announced the Livongo merger in August, the share price would probably ended up a lot higher. And this weird final case brings us to the benefits and drawbacks of investing in biotech. So first, let's acknowledge that Cathie Wood did a great job managing this portfolio and got some amazing results over the past 5 years, with 2020 being a spectacular year. With that said, biotech stocks seem to be a very risky business that doesn't always make a lot of sense when the stock goes up and doesn't take a lot to send the stock crashing down. The huge operating costs involved really press down hard on the sales generated, so you have many companies that do great in terms of gross profits only to end up with massive net losses. This makes it very hard to determine which company is on the right path and which stock will see large gains. You need more insights on the products, the positioning of the company, and the direction of the management. And this means you have to be a specialist in the biotech industry to be able to pick the winners. Once you do, you also need about 1 to 2 years of patience to see some good results, since the stock prices can remain very stable or even decline, regardless of strong financial results. Luckily, you now have a company to do all of this for you. You can invest in the ARKG ETF and ride the wave of gains without having to do any of the hard stuff, or you can also build your own portfolio based off of this portfolio. This was the breakdown of Cathie Wood's stock portfolio. Please like and subscribe to the channel for more finance and banking information.